Well, U.S. stocks losing some steam after 41 record high closes of the year. But our next guest saying that history suggests that the rally is going to continue post-Fed rate cut. Joining us now, I want to bring in Ryan Detrick. He was just cited from our very own Jared Blickery. Ryan Detrick is Carson Group's chief market strategist. Ryan, it's great to talk to you. So you are very optimistic about where stocks are going to head from here. Why are you at all concerned that maybe the 50 basis point cut is a signal that things could be weaker than we thought on the economic front?
Yeah, good morning, everyone, and glad to be back talking about stocks at new highs. You know, I've come on all year saying we're pretty optimistic that this is a bull market. We're still in that camp. Now, the big question, of course, they just did 50. We're of the opinion they probably should have done 25 7 weeks ago. So maybe they just brought the eraser out. And the big argument is the economy slowing? Because, yes, they cut 50 before in 2001 and 2007 and a 100-year pandemic. Not very good times. But we still think, again, what I've said all year with you, inflation is last year's problem, right? So we don't need interest rates over 5% right now. And you look at the economy, I could talk all day about this, keep it fairly simple. Is the labor market slowing? Yes. But look at initial claims, one of the best indicators we have for real time, what's going on with the labor market, hit a 4-month low just last week. Oh, one more thing, earnings. I mean, earnings do matter. Forward earnings on the S&P 500 has hit 267. What in the world does that mean? It was 225 this time at the start of 23. So are things perfect? No. Is the economy slowing down? Yes. Are we going into a recession? No, we don't think so. And we think these rate cuts are going to continue to kind of juice this bull market and honestly help this economy going forward.
To what extent? I mean, what type of percentage have we seen in the past to suggest that we could see even more upside from here? As I'm looking at some of the stats that Jared brought up and that you were posting about as well this week, 41 all-time highs for the S&P 500 in 2024.
Yeah, 41's an awfully lot. Extrapolates out to up over 50, which would be one of the most ever. But, we took a look at kind of, can the Fed cut interest rates near all-time highs? Because people are wondering that. Yes is the answer. I'm back to 1980, found 20 times they cut interest rates within 2% of an all-time high. 1 year later, higher, 20 times, Brad. And the average return about 13.9%. So let's just round it to 14. Are we going to have two back-to-back 20% years? It's looking like it, right? Will we have 3? Probably not. But at the same time, double-digit returns this time into next year if the economy hangs in there. We think it's possible. Now, one more comment on this. That's large caps, right? I've come on with you all year saying we like small caps. We like mid caps. Mid caps have been our largest overweight all year. And historically, when do those really start to outperform? It's once the Fed actually starts cutting, right? We saw that big rally last year, or late last year. We thought the Fed would cut sooner. Then we had the jump in inflation and in the economic data the first quarter this year, which pushed things back. But now that the Fed's actually cutting, we think small and mid caps will probably outperform large caps over the next year.
Ryan, what does that upside look like, do you think?
Well, like I said, upside with the S&P 500 this time from right now to, let's say, come back in 12 months, right? A year from now. We wouldn't be surprised at all. We had 12 to 15% returns on the S&P 500, but small caps and mid caps, honestly, could probably be more than 20% or so. Low 20% or so is what we think is possible. And that's the thing about this market, right? I mean, everybody's like, large caps here and small caps there. Everybody's arguing about everything. I mean, sometimes a diversified portfolio, sticking with kind of, rebalancing every 3-6 months or so, that's the best thing for a lot of investors out there listening. I mean, don't always chase a shiny object. We've been neutral. Last comment. We've been neutral technology most of this year. A couple, 3-4 months ago, people thought we were crazy to say that. There are some really stretched valuations in technology. Doesn't mean we don't like it. Again, we're neutral, but there's some other areas like financials, like industrial, small caps, mid caps that are pretty cheap historically, and those areas we're overweight.
Ryan, are you just looking past the election and any uncertainty that could cause, given the fact that you are so optimistic about the returns that we could see over the next 12 months?
Can we just look past the election? Is that okay? Yes. Well, let me put it this way. The second half of September, like Jared just talked about a little bit, is usually when the volatility happens. Well, not so far this year, but it is October coming up, the worst month in an election year, the most volatile month historically. We're thinking it makes sense. We're going to have probably that October election surprise, whatever it might be, some October volatility. Just remember, though, once you get through the election, markets can take bad news, markets can take good news. They just don't like uncertainty. We're going to have a lot of that. And the good news for investors out there, November historically is very strong in an election year, and December is too. So if we get some rockiness in October, that's okay. One more thing on this. I mean, S&P is up 9 of the last 10 months. All right. The only month we've been down is April, which usually is a pretty good month. So go figure there. So we might be up 10 out of 11 months here if we're higher in September. So this has been a great move. Markets don't always go up. Maybe we're due for that October volatility. But again, bigger picture, we would be actively buying any weakness for into your rally and even into next year.
Ryan Detrick of Carson Group. Ryan, always a pleasure to catch some time with you. I mean, I enjoy tracking your posts, but it's better IRL, or at least over the interwebs, in the metaverse, or, just this simulcast.
Thank you.